Very good morning to all. I hope you are doing great. I am also good. Very warm welcome to my YouTube channel. My name is Dr. Reena and I am so happy to have you here. In today's video, we are going to talk about these topics, leverages, and in which we are going to discuss about the three things: operating leverage, financial leverage, and combined leverage. After that, we are going to discuss about this topic EBIT, EPS analysis and financial break-even point and indifference level. So let's understand these topics thoroughly one by one. Okay, so before understanding these topics, let's understand this thing why we need to study leverage and these topics that I already mentioned in the starting, like EBIT, EPS analysis, and financial break-even point and indifference level. So why we need to study these topics? So this is the answer of these questions. Basically, leverage is a crucial in finance as it helps businesses, companies, and investors to understand the impact of fixed cost and debt on profitability. So these concepts are very essential for first reason behind that risk assessment, and second reason behind that profitability management, and third reason we have capital structure decision, and the fourth reason we have break even analysis, and the fifth reason we have investment decision. So let's understand these one by one. Risk assessment, that means understanding how fixed costs and debt affect earning volatility. And second reason behind that profitability management, which means where we need to determining how small changes in sales impact earning. And third reason we have capital structure decision, that means by choosing between equity and debt financing, which one is the best one, equity or debt, for the company or for the business. And next we have break even analysis, where we are going to determining the minimum earning required to sustain the business. And fifth reason we have investment decision, where we are going to assessing the financial health of companies before investing. So let's understand these topics thoroughly one by one. Let's start with the operating leverage. So basically, what is the operating leverage? Let's understand this thing first. Operating leverage refers to the use of fixed cost in a company's cost structure, and it indicates the extent to which fixed operating expenses like rent, salaries, depreciation, etc., which include under the operating leverages. And these things, these expenses impact the earning before interest and tax, and which we can call it EBIT. So let's understand this thing how operating leverage works. If basically a company with high fixed cost but low variable cost has high operating leverage. This means when sales increases, the profit increase significantly due to the presence of fixed cost. And when sales decreases, the company still have to cover the fixed cost, leading to the higher losses. So there are the two options, like if sales are increases, then profit automatically increases in the company, and when sales are decreases, then company face the losses. So let's understand about the formula of degree of operating leverage. So you can calculate the leverage of operating leverage by this formula: percentage change in EBIT divided by the percentage change in sales. So in this way you can able to calculate the degree of operating leverage. And the second formula we have degree of operating leverage, contribution divided by EBIT. If contribution given to you, so then you can solve the question like that. Okay, if EBIT and contribution given in the question, so you can calculate the degree of operating leverage by using the second formula. where contribution is equal to the sales minus variable cost and EBIT is equal to contribution minus fixed cost. So let's understand this operating leverage with with the help of example. Okay, so let's consider two companies A and B, and where the particular are sales, variable cost, and fixed cost EBIT. In the company, these are the values are mentioned according to the particulars, and in the same way for the company B, the particulars are mentioned in the series wise. So you can see here. Now let's calculate the degree of leverage. So for company A, first of all, you have to use the formula second one. Okay, in that way you can able to calculate the degree of leverage. And since the company A has a higher degree of leverage, that means its profit will rise or fall more drastically with changes in sales. And what is the significance of operating leverage? If high degree of leverage, that means high fixed cost, and there are high risk but also high potential return. In case of low degree of leverage, that means low fixed cost, and where low risk, that means but also lower return. The second, we have the financial leverage, which means the financial leverage occurs when a company uses the debt to finance its operations. It measures the impact of interest expenses on earning per share. EPS, that means earning per share. And how it works? It works like that. If there is a high debt, that means high financial leverage, and there are greater potential return but also higher risk. And in case there is no debt, that means low financial leverage and lower risk but also limited returns. So this is the formula of calculating the degree of financial leverage, where the percentage change in EPS divided by the percentage change in EBIT, and where DFL is equal to EBIT divided by the EBIT minus interest. So in this way you can calculate the degree of financial leverage. So let's understand this financial leverage with the help of a example. So consider two companies, one financed purely by equity and other financed with debt. So these are the particulars irrespective of company X and Y. And for company X there is no debt, and the company Y with debt. So these are the values. In case of EBIT for company X 50,000, and for the company Y there is the same debt, it's 50,000, and interest in case of company X 0, and in case of company Y there is a 10,000. In the similar way, EBIT, that means earning before tax, is 50,000 for company X and 40,000 for company Y. So let's calculate the DFL. DFL, that means degree of financial leverage, for the company X and company Y. So you can use the formula here. Okay, this one, EBIT divided by the EBIT minus interest. So in that way you can calculate the degree of financial leverage, and here you can clearly see that in case of company X there is the answer of DFL, that means degree of financial leverage is 1, and in case of company Y degree of financial leverage is equal to 1.25. So since the company Y has a higher DFL, that means degree of financial leverage, it has higher risk but greater potential return. So what are the significance of financial leverage? If there are the two cases. First case, we have if high degree of financial leverage, that means high risk and profit are volatile. And in case of low DFL, that means low degree of financial leverage, that means low risk and stable but limited growth. And it is used to determine the impact of debt financing on a company's earning. Third, we have combined leverage. So let's understand the combined leverage thoroughly. Basically, combined leverage shows the total impact of operating and financial leverage on a company's earning, and the formula for degree of combined leverage is equal to degree of financial leverage is equal to degree of leverage into DFL is equal to the percentage change in EPS divided by the percentage change in sales. For example, in case of combined leverage, DOL is equal to 2. DOL, that means degree of operating leverage, and DFL, that means the degree of financial leverage, is equal to 1.5. And then DFL is equal to 2 into 1.5 is equal to 3. So this means a 10% increase in sales will result in a 30% increase in EPS. Okay, so what are the significance of combined leverage? It helps the businesses to understand the overall risk. High DCL, that means the degree of combined leverage, that means the high risk and high reward businesses. And in case of low DCL, that means the low combined degree of combined leverage is equal to low risk, that means steady business. Okay, so how you can take the decision for a company? If EBIT is low, that means equity financing is better. If EBIT is high, that means debt financing is more profitable. So next topic we have the indifference point. Indifference point is the level of EBIT where EPS remains the same for both financing option. EBIT is equal to EBIT. Okay, so in that case EPS is equal to EBIT minus interest 1 divided by the share 1, and is equal to EBIT minus interest 2 divided by the share 2. In that way you can calculate the indifference point. And let's take an example to understand this concept. For company A, there is a equity financing and 10,000 shares, and for company B there is a debt financing and 10,000 interest and 5,000 shares. So by solving for EBIT where EPS is equal helps to determine where debt becomes a better option. Next topic we have financial break-even point and indifference level. So basically the minimum EBIT required to cover the financial cost. EBIT is equal to interest plus preference dividend 1 minus tax, and a company below this point loses money. So financial indifference level where the EBIT level where two financing plans produce the same EPS. So what is the importance of financial break-even point? It helps the businesses to decide when debt financing becomes more profitable. And higher break-even point, that means higher risk for the company, for the business. So come to the conclusion of these topics. By understanding the leverages concept is essential for financial planning and risk management. In case of operating leverage, it impacts the EBIT due to fixed cost, and in case of financial leverage where it impacts the EPS due to the interest cost, and in case of combined leverage it shows the overall business risk. And EBIT and EPS analysis that helps in capital structure decision, and whereas the break even and indifference point which helps us to determine the financial stability. So these concepts are critical for businesses and investors to maximize return while managing risk effectively. So these are the questions based on the topics that we already discussed. The leverages where financial, operating and combined leverages that we already mentioned, EBIT, EPS analysis, financial break-even point and indifference level. So these are the questions that based on these topics only. Okay, so first topic we have the operating leverages. So these questions are based on this topic only. First question we have, which of the following best describes the operating leverage? And the right answer is B, ability of a firm to use fixed operating cost to magnify EBIT. Next question we have, which formula is used to calculate the degree of operating leverage? And the right answer is A, contribution divided by the EBIT. In case of operating leverage, you have to be keep this thing in your mind. Like in case of operating leverage, we take EBIT, contribution divided by EBIT. Next question we have, what does operating leverage measure? And the right answer is the effect of fixed cost on EBIT. Second question we have, a firm with high operating leverage is characterized by, and the right answer is B, high fixed cost and low variable cost. Next question we have, high operating leverage is associated with which of the following? And the right answer is high fixed cost and low variable cost. And the fourth question we have, financial leverage arises due to the presence of which cost in a firm structure? And the right answer is C, fixed financial costs such as interest. And the next question we have, which formula is used to measure the degree of financial leverage? And the right answer is EBIT divided by the EBIT minus interest. Next question we have, the combined leverage, consider the effect of which two types of leverage, and these are the operating and financial leverage. Next we have the formula of degree of combined leverage is equal to degree of operating leverage into degree of financial leverage. So in that case you can able to calculate the degree of combined leverage. Next we have the EBIT, EPS indifference point is the level of EBIT at which, and the right answer is B, EPS remains the same for different financing options. Next question we have, the financial break-even point is the level of EBIT at which the firm EBIT is equal to the interest expenses and preference dividend obligations. Next question we have, if a company has a higher degree of operating leverage, a small increase in sales will result in, and the right answer is A, the proportionality higher increase in EBIT. Next question we have, if the degree of financial leverage is greater than 1, it means the company has a mix of debt and equity financing. And next question we have, which of the following statement about leverage is true? And the right answer is C, operating leverage is concerned with fixed operating cost. And what happens when a firm reaches the EBIT and EPS indifference point? And the right answer is C, both debt and equity financing give the same EPS. Next question we have, the firm with high operating leverage should focus on the increasing sales volume. Next question we have, if a firm EBIT is less than the financial break-even point, then the firm will not be able to cover its fixed financial cost. Next question we have, what does operating leverage measure? The effect of fixed operating cost on EBIT. Next question we have, a firm with high operating leverage is characterized by, the right answer is B, high fixed cost and low variable cost. Next question we have, the degree of operating leverage is calculated as the contribution divided by the EBIT. Next question we have, what does financial leverage measure? The effect of financial leverage, the effect of fixed financial cost or interest on EPS. Next question we have, the degree of financial leverage is given by the EBIT minus interest. Which of the following is an example of financial leverage? So right answer is B, the firm using long-term debt to finance operation. And the next question we have, which of the following is the correct formula for degree of combined leverage? And the right answer is A, DOL into DFL. That means degree of operating leverage into degree of financial leverage. If a company has a degree of operating leverage is 2 and degree of financial leverage is 3, what is the combined leverage? It's very simple. So you have to multiply the both and you can get the answer easily. It's 6. the EBIT EPS analysis help in? And the right answer is A, determining the optimal debt equity mix. Next question we have, the EBIT EPS indifference point is the level of EBIT where the EPS remains the same under different financing options. And the next question we have, the financial break-even point refer to the level of EBIT where the fixed financial cost, interest and preference dividend are covered. Next question we have, the degree of financial leverage is greater than 1 when the company has a mix of debt and equity financing. Next question we have, if the degree of operating leverage is high, a small increase in sales will result in, and the right answer is A, the proportionality larger increase in EBIT. Next question we have, the EBIT EPS analysis is used for, and the right answer is B, capital structure decision making. Next question we have, the firm with a high degree of financial leverage DFL is more sensitive to, and the right answer is changes in EBIT. Next question we have, if a company has no fixed financial cost, its financial leverage is 0. Next question we have, a firm that relies heavily on debt financing will have a high financial leverage. And next question we have, a firm reaches its indifference point when two financing options result in the same EPS. And next we have, if a firm EBIT is lower than its financial break-even point, it will not be able to cover the interest and preference dividend payment. And next question we have, the high operating leverage is more beneficial when the firm expects increasing sales. So that is all about for the today's video. Thank you so much. If you like this video, then subscribe my channel. So bye bye, take care, have a nice day, keep learning, keep growing and keep signing.